morning and welcome to another episode of PwC's Boardroom Forum Live. I'm Rianti Padiachi from PwC, and today we're talking about what can sometimes be seen as a contentious issue: executive remuneration. In a previous Boardroom Forum session, we discussed trends in executive pay and remuneration, which is discussed in great detail in our 2022 Executive Director Practices and Remuneration Trends Report. The report analysed executive pay during the period 1 March 2021 to 28 February 2022, focusing primarily on executive remuneration within JSE-listed companies. Today, we'd like to build on that conversation and consider how typical employee remuneration awards are disclosed in annual financial statements and what to look out for when considering those transactions and disclosures. Joining me for that conversation is Ronal Fourie from our Corporate Reporting Services Division. Ronal, always a pleasure. Thanks for sitting down with me again. So to jump straight into it then, what would you say are some of the accounting standards to bear in mind from an international financial reporting standard, so an IFRS perspective, when it comes to employee remuneration awards?
Thank you, Rianti, and thank you so much for inviting me again. So before our listeners or our viewers actually switch off because it's accounting standards, there's certainly been a lot of complexity around these schemes. Right. And we see quite a number of companies tripping up because they're getting some of the details wrong. So that might result actually in restatements. So we really want to delve in at a high level, I suppose, to look at these standards. So two of them that are applicable is firstly IAS 19, which is our employee benefit standard, and then secondly IFRS 2, which is our share-based payment standard. So both of those could be applicable to schemes with employees, and as you say, to executive pay. We also see, though, that the accounting could be a bit broader than that, because you might find that the structure is set up through a special purpose vehicle. And this special purpose vehicle, when you look at that, you have to consider if it should be consolidated or not back into the group. So a lot of complexity that has to be considered.
Now, you mentioned the consolidation of structured vehicles as one consideration. But what would you say is the difference between the other two standards you refer to as it relates to, for example, long-term incentives, so your LTIs?
So that's a good question, and I think something that in some of the schemes could be missed. So the two standards really have the same principle, the same underlying principle, and that is that the employee is entitled to a benefit, but that benefit accrues to the employee as they work for the benefit that they're entitled to. So for a long-term scheme, that would mean if you're supposed to work for 3 years, the expense to the company would be over those 3 years. And often these schemes, so both share-based payments or employee benefit schemes, have good and bad leaver provisions. So if you're not around at the end of the 3 years, you might forfeit that scheme. And that needs to be taken into account in the valuation of the actual transaction or the expense.
Okay, well, that certainly makes sense then. Now, we've seen that financial disclosure statements can be extremely lengthy, pages and pages of disclosures about share-based payment awards, etc. But can you tell me a little bit more about these share-based payment arrangements and what they entail?
So the standard deals with more than, the standard on share-based payments deals with more than just employee benefits. So any transaction in which an entity receives goods or services and pays for with its shares, that actually falls within the scope of the standard. Because employee services can't necessarily be measured, you would have to look at what the outcome of the scheme is. So is the employee receiving shares, which means you'll value the shares that they're receiving? Is the employee perhaps receiving an appreciation right? So a share appreciation right says, for example, we start with a base of a share price of 10. Okay. In 3 years' time, whatever growth has happened in the share, we'll pay that out to you. That's still a share-based payment, but it might then actually be settled in cash. So all schemes that relate to any type of a link back to the company shares would fall within the scope of IFRS 2.
Okay, can you give me an example of what different schemes or awards look like?
So the most typical ones, I suppose, or the most common ones and simpler ones would be a short-term employee benefit. So a short-term employee benefit is paid within 12 months after year-end. It's based on, say, an annual performance target. So at year-end, management would estimate what that performance target, if it's met or not, they'll accrue for that particular award and it's accounted for. As I mentioned before, the other types of schemes we see long-term schemes with performance targets, and then always some kind of an employment target linked to that, because you want to incentivize your employees to stay on. That's usually the objective of these schemes. And that can either be linked to the share price, or then if it's a normal employee benefit scheme, it can be linked to some kind of another target, like an EBITDA target. Yeah, so those are the typical ones that we see.
Okay, I think just to continue with that train of thought, and while we're talking about examples, what if an employer wants to benefit the community, for example, right, by providing bursaries to the children of its employees?
So that's a good question, and we see a lot of schemes. So we're not talking about the broader scope of IFRS 2 from an accounting perspective, or share-based payments. So often the structures look the following, or set up in the following way. So you have a special purpose vehicle, and that entity receives funding actually to acquire shares in a company. And these shares are then used as a funnel to, pay dividends into the structure. So then it has cash flow. And once it has cash flow, the trustees of the trust or special purpose vehicle can actually allocate these to designated beneficiaries. Like you've mentioned, the community, employee children, your broader community, maybe previously disadvantaged individuals. So they use that in order to benefit whoever the trustees are assigned to pay out to. So that's a typical structure that we see. That's also within the scope of, potentially within the scope of IFRS 2, but more often we see that these schemes are actually only a donation. So as soon as the dividends flow into the structure, and the dividends flow out to the beneficiaries, all that's happened is there's a donation that's been made to someone outside of the group. So then you're actually outside of the scope of IFRS 2, and you don't have a share-based payment to account for. So you can see that there's quite a bit of complexity, a bit of devil in the detail, but certainly we see that quite often.
Yes. Well, it's good that we have the expertise to guide clients on this, for sure. Now, Ronald, you touched on it before, but can you perhaps expand on the estimates that are taken into account when determining the value of these employee benefit awards? As I can imagine, there's a lot of complexity that lies, therein.
No, definitely, and it's something that might only be picked up at year end. And then it's a little bit late, because you might need to bring in specialist advice and valuation expertise. So for example, if you have a long-term incentive plan, which is in the scope of IAS 19, as another long-term benefit, the standard actually requires you to apply the same valuation methodology as you would for a defined benefit plan. Now, what comes to mind immediately, like actuarial valuations. So you might actually need actuarial inputs to assess forfeiture rates or, performance measures, estimating if those performance targets will be met or not. So there's quite a bit of complexity, and you might need to bring in specialist advice. For share-based payments, on the other hand, the valuation there is an option pricing model. So there you can apply Monte Carlo, binomial. It really depends on the complexity of the scheme what type of vesting conditions or performance conditions are within the scheme. And there again, you might need expert advice. So something that really shouldn't be left to last.
Well, it's definitely technical and complex, Ronald. From a practical perspective, however, is there any final advice to bear in mind when accounting for employee benefits?
So certainly, I think taking a step back, I would recommend that the audit committee board members become familiar with the terms of the schemes in which the companies have entered into. And then see if the disclosure and the financials actually reflect their understanding of those terms and conditions. And if it's telling the story about the fund, and if it's giving sufficient information for users to understand the financial impact on the statement of financial position, so the balance sheet, or the statement of comprehensive income or the income statement. And then lastly, but not least, is to challenge management to have those valuations in place ahead of time. Some of them need to be repeated annually. So to have those processes in place and to ensure that those estimates are robust and are disclosed appropriately.
Yeah, very important things to remember. Well, thank you, Ronald, for sharing your technical insights with us this morning. And thank you to you, our online audience, for tuning into another episode of Boardroom Forum Live. We'll see you again next week on our PwC LinkedIn page.